Well, this panel is meant to bring to the group the investors, the folks who are behind all the activity, the folks who are said to be too numerous, too much equity, too aggressive, too much capital floating around. If anyone in the room is to be blamed for that, let's start with it being the folks on this panel, and that's going to be the premise from which we operate. We're very fortunate to have four very senior, very experienced, and very active investors representing large institutions who, in their own way, much to their regret sometimes, can move the market. Peter Ballon, who's sitting closest to me, is head of real estate investments for the Americas for the Canadian Pension Plan Investment Board, one of the largest institutions in Canada and one of the largest real estate investors today in the world. Peter's responsible not only for investing in the U.S., but investing in Canada, Mexico, Brazil, in fact, all the Americas. Next to him is Pete Madden. Pete is with APG Asset Management. Some of you may have known the firm before as ABP, one of the largest Dutch investors globally in all asset classes, and again, one of the most active global investors in real estate. Pete's responsible for the Americas as well. He's co-head of the group and has been active both in the U.S. and in Latin America. Next to Pete is Yvonne Nelson, who is the Executive Director for Real Estate and ETI in the New York City Controller's Office. So in that role, she's responsible for direct investment activity in real estate on behalf of the New York City Pension Fund, and she'll give you some of the dimensions of both the pension fund and their real estate activity as well. And finally, Andrew Trickett, at the far left to me, is, although not politically, is responsible for investments in the U.S. For Oxford Property Group. Oxford is also Canadian and is a very interesting company given their structure and their ownership, and Andrew's going to be able to give you a little bit of insight into that as well. Somewhat unusual in the world of operating companies and their relationships with parent institutions like the pension fund that's his parent. So, with those introductions, I'd like to start off the questioning, and I'd like to start ladies first for Yvonne. Yvonne, could you describe briefly how the pension fund invests in real estate and your own role there?
Sure. Good afternoon, everybody. Appreciate you staying here right before lunch. So I'm kind of certain that you're probably alert because hunger tends to do that. So, you know, hopefully we'll be able to give you some satisfactory comments to kind of bring back to your office and your head. Meanwhile, just to kind of give you a brief overview of New York City's initiative in real estate. As an asset class, it's relatively young, still less than 10 years old in terms of a program in alternatives. But the New York City Controller's Office, where I have the position as head of real estate, is the business advisor for all of the New York City pension plans. The largest pension plans are about 5 in number, so that's employees, teachers, police, fire, and the Board of Ed. We serve a membership of about 600,000 active and retired members. And as it relates to how we invest in real estate, we have a relatively small staff, although we do have some restructuring plans in play that you probably have all read about during the past week. But right now, staff-wise, we're small. So we have been investing our $7 billion real estate allocation primarily through funds. We have about 40 investments right now. We have about 25 different managers that we're working with. It's a global portfolio, and I use that kind of loosely because I think across the systems we are probably about 10% international at this particular point. We are active investors in every cycle, although I would have to say that we've committed as much as $1.5 billion in a certain year. Since the downturn, we've kind of turned it back up selectively. And '09, we were, in 2010, we were probably about 400 million. This year, we'll probably be somewhere between 500 million and 600 million.
Thanks, Yvonne. Peter Ballon, tell us a little bit about how your organization approaches real estate.
Sure. So just to give you some context, the Canada Pension Plan is a $150 billion fund. Perhaps what differentiates us isn't our size, it's more where we are in our stage of growth. We are at a stage where our net inflows from our contributors, which is essentially all the Canadian citizens that are employed outside of Quebec, are required by law to contribute to the plan. And we have net inflows from year to year varying from $7 to $9 billion, and that's exclusive of the investment income. We're still at a very early stage of our development. We expect to double in the next 5 to 7 years. So we're kind of like maybe have a kid going through a growth spurt in that 5 years ago we had no investment in real estate. We now have $13 billion in real estate. In the past 6 months alone, we invested $4 billion in equity around the world. 2/3 of that was outside of the U.S., 1/3 was here in the U.S. We don't have what differentiates us from some of our peers. We don't have allocations. Every single investment we make has to kind of compete with what we call the total portfolio approach. We're competing with other dollars within the organization. So we have to be able to prove that our real estate investments can provide a better return than the other investments that we invest in across different sectors. So the past doesn't necessarily predict the future, but given our size, we do expect to continue to be quite active in real estate.
So given the fact that you're a global investor in all asset classes, what's the relative proportion of real estate in terms of U.S. for this group versus non-U.S. Real estate versus total assets? Is it disproportionately high real estate in the U.S. or disproportionately low? It's
actually disproportionately low. 2 years ago, we had virtually no real estate in the U.S. And given our history, we had I don't know if overweighting is the right word, but we had a very high concentration in Canada. The Canadian market's a very small illiquid market, and so all of our growth going forward will be outside of Canada. And we expect the U.S. to be a big part of that growth.
So since we have two folks from Canada on the panel, I'll ask each in a row. But Peter, please tell us a little bit about how the tax regime works between Canada and the U.S., how you structure transactions in light of that tax regime for those of the folks who might be interested in that.
Was that for me? Yeah.
Start with you.
Yeah, sure. The Canada Pension Plan is a fully taxable paying entity in the U.S. Having said that, there are some vehicles that allow us to be tax efficient. Most notably, anyone who partners with Canadian investors or any foreign investors usually hears about domestically controlled REITs. What that allows foreign investors to do is to invest through a REIT vehicle. These aren't public REITs necessarily. In fact, what we almost exclusively invest in are private REITs, which can literally own just one asset. That does impose some restrictions. For us to be tax efficient, we need to own less than 50% of that REIT. So you often hear about 49% ownerships by foreign investors. Another little caveat, and that's why we're all slightly different as foreign investors. Some foreign investors need what I refer to as domestically controlled REITs, which means the 51% has to be U.S. domiciled entities. The Canada Pension Plan and other entities fall under something called Section 892 that allow us to invest with partners that are not domestically controlled. So that gives us a little bit more flexibility. And the final note to be aware of for us so our income is tax efficient while it's in the REIT, and for us to exit tax efficiently, and that was a change that came about a few years ago. The asset could not be sold from the REIT. We have to be able to sell the shares of the REIT to exit tax efficiently. And that is an extra layer of complexity that we'd like to avoid, and a lot of foreign investors are campaigning to have that change repealed.
Is that Congress that has to change that?
I believe so.
Okay. Andrew, let's skip to you. Tell us a little bit about how Oxford is organized and especially its relationship to its parent.
Sure. I guess a couple of things to note. Oxford Properties Group is a fully integrated real estate company. We happen to be sponsored by Canada's third largest pension plan. So our capital comes from the pension plan, but I wouldn't describe us as a pension plan. So Oxford has 12 to 1,300 employees. We are a fully integrated real estate company in Canada. Today we have about $19 billion gross assets under management in real estate. In Canada, again, as I described, we are in all asset classes. We actively manage that portfolio on behalf of our own capital, as well as some great partners, Peter and CPP being one of them in Canada. And so we, at least in terms of how OMERS is structured, OMERS really has decided as a pension plan to be a much more active investor in all of its private businesses, and real estate is no exception. By having actually acquired Oxford in 2001 as a public real estate company in Canada, they actually privatized it off of the Toronto Exchange and brought it all in-house. And so now Oxford represents OMERS investment arm for all real estate, being it in Canada or globally. We are heavily invested in that $19 billion in Canada. About 85% of that investment is in Canada. 12 billion of that 19 is our own, so we do manage, again, on behalf of third parties. So our growth going forward, as OMERS continues to grow, as our pension is, as our capital source, is to invest both in the United States and in Europe.
So the question that was debated pretty hotly in the last panel, private versus public, actually is an unusual solution that OMERS, the Ontario Municipal Employee Retirement System, came up with, which is to actually buy a public company, take it private, and then execute its real estate strategy through that company.
Right.
I find that fascinating, and if not unique. In fact, I would challenge anyone in the audience to show me another example of that. Maybe you know another example, Andrew.
Actually, there's two
There's
other
quite a few
examples.
in Canada, actually.
Great.
There are others in Canada.
Actually, it's almost the Canadian model.
Go ahead.
Cadillac Fairview.
No, I meant in the U.S., forgive me.
Okay.
But give us the Canadian examples as well.
So the other two examples, and so in fact CPP is more on the unique side, not suggesting better, but certainly unique, in that in Canada the Cadillac Fairview, which is well known as and one of Canada's other large operators, is owned by Ontario teachers. And the Caisse de Depot, call it our sister in Quebec, they own a company called what's now called Ivanhoe Cambridge. That would have a similar model to Oxford. Having said that, I do think that model is kind of a Canadian model rather than a...
So just imagine CalPERS buying Vornado and taking them private and then running them. Interesting concept. Those are just illustrative names, by the way. So, Pete Madden, your company is based in the Netherlands. I spent many years working for a company based in the Netherlands, so I appreciate where you're coming from. Tell us a little bit about that.
ABP, we invest in real estate. We're about probably 9% of our plan is invested in real estate globally. When your country the size of the Netherlands, you have to be global. We break ourselves up. We have offices in the Netherlands, Hong Kong, and the U.S. The U.S., which I work in, is responsible for the Americas, U.S., Canada, and Brazil. We currently have, very active in the U.S. and Brazil, but we haven't been able to really get into Canada yet. We invest both public-private. We view the public REITs as core real estate for us, so we have a very large concentration in the public real estate sector. On the private side, we typically invest through funds. A lot of that is because of tax structuring, as Peter was mentioning. We need to be domestically controlled, and we can't be more than 49%. Most of the funds that we go into are more operator funds. We like the operator funds because we feel we get better access to the actual properties without having an additional layer of fees on top of that. And you can also, they're usually smaller funds where you can really dictate terms and governance and investment restrictions and rights to make sure the fund is operating the way you want to operate.
So let's take a market view, and maybe we can start with Andrew. Two questions, take whichever one you want or both. What's your market view of the U.S. in general versus other non-U.S. markets, whatever they may be, emerging or stable? And number two, what's your view of New York market in particular, and what have you done to express that view? We'll start with you.
Sure, I guess I'll take both because I think we have a strong focus on the U.S. as a market. So our view on the U.S., although I describe my personal view, and I think some of our firms as well, is that short-term volatility is likely in the U.S. and continue to be in the U.S. But we have a very bullish long-term view. We also share that view and have kind of put our money where our mouth is as it relates to that view in New York specifically. We are partners with the related companies in a small development on the west side. of New York. So we're making a very long-term bet on this city, its need for new product, as well as being a world-class city for property users, et cetera. So we have a big view on New York. We've also transacted quite quietly in a space that was talked about on the last panel a lot, which I think, again, for an institutional investor, at least from people's perspective in the audience likely, around the debt space. So we've spent a lot of time in the face of recapitalizations. We've acquired debt. We've provided both pref equity or unsecured notes, as we like to call it, from a tax perspective. And so we've done a lot of that kind of product as well, and a lot of that's been in New York. So.
And when you're investing in debt, are you investing in it to be a lender, or are you investing in it as a substitute for equity because you think the returns are equity-like and you'd have a different risk structure?
Yeah, I think from our perspective, we're not a first mortgage lender, so from that perspective, that's not a space we're looking to fill, but rather, I think as someone described in the last panel, if we can find a slice of the capital structure that's in the 65 to 85% range at unlevered returns that are in the 10, 12, 14 for a product we would love to own for equity, but like that pricing better as will you see us.
So using the typical modesty of a Canadian person, you referred to the project as a small project here in New York. But what you were referring to, I think, was Hudson Yards.
That's correct.
And why don't you tell us a little bit about what's happening at Hudson Yards from your perspective as one of the owners? We read in the papers about big leasing being done, but give us a little sort of inside perspective.
Sure. I think two things to note for the audience in terms of how we participate in that investment, as well as obviously our long-term view on it, and some activity. From an investment perspective, we're actually co-general partners with Related, unlike maybe some of the descriptions around investing in the United States or in other markets on a 49% basis. Oxford is flexible in that regard, and I think it's as much about the investment, type of partner, as well as the type of return. In that particular instance, we have a great relationship with Related. They are obviously the locals doing a lot of the legwork, but we're involved in all that decision making with them, both in a general partner as well as going forward as a potential limited partner in a capital raise. There has been a ton of activity around the site, obviously some public activity around a very recent tenancy. We're having ongoing discussions with upwards of 5 to 7, and Stephen Ross will probably say it better than I later this afternoon. Multiple tenants in the $1.5 million to 2 million square foot range. It is a very complex project. It will take a great deal of time to unearth the value there for us, but we again are very bullish in terms of what we can get done and accomplished.
And you chose the word unearth carefully,
That's
right?
Create some earth.
So you mentioned that Related is the local folks, but let's not forget you live and work in New York City.
That's correct.
So let's compare and contrast. Peter, you effectively, or you invest in the U.S. very effectively, but you're domiciled in Toronto. So how do you access the U.S. market not having an office with direct employees here in the U.S.?
It's a very deliberate decision of ours. Well, first of all, we do have offices in Hong Kong and London, but it's a very deliberate decision that we've made that we are capital allocators. We are not trying to replace our partners. We think, because we have this global mandate, that we can't be operators everywhere we go. So we want the next best thing, which is the flexibility to pick the very, very best partner in every single market we go into. And so far, that has been a reasonably successful model. We're able to come into a market like New York here. We have partners such as Vornado, SL Green, and Rockefeller as examples. In the mall sector, we have GGP and Simon. And so we think that by being able to partner with the best in class, it gives us a competitive advantage. Us coming down to the U.S. and trying to get into the mall business and doing it ourselves would have a zero chance of success. So it's a completely different model. I don't think I actually don't believe there's a right or wrong. We do give up some things by having partners. We don't always participate in all of the development upside, as an example. But I think if you're going to be a truly global organization, you either have to have local operations everywhere, which we as an organization don't think is feasible, or you have to take a capital allocator model, which is to really pursue what we think are best-in-class partners everywhere.
So Yvonne, on this panel at least, you're representing the traditional U.S. public pension fund, but you're nothing. You're not traditional in any way. So please tell us how you access the market. You said you've invested $400 million last year and between $500 and $600 million this year, if I remember correctly. How do you access the market, and how do you do things differently than, say, the typical U.S. public pension fund?
Okay, well, The $600 million that I mentioned, about 1/3 of that is a major commitment in a New York-centric JV. It's essentially a captive fund. It's the operator and ourselves. They have their skin in the game. Just to kind of give you some background, like probably many U.S. institutional investors, when you kind of look at your real estate portfolios and how it was impacted by the crisis. Although, as I mentioned before, we're not fully invested, some of the investments that we did have, went through a very turbulent period. And I know that you'll get to this later. Fortunately, we're now focused on new investments, whereas in the past 24 months, we were involved in weekly calls on various restructures and what have you. That led us to an exercise to look at our existing managers and just strictly from a performance point of view to kind of figure out who's going to get the next dollar, right? I mean, we came into this asset class. We diligenced the brand names, the folks who were established in the business, and you know as well as I that some of them are not around anymore. So we had to kind of, be introspective, kind of figure out what can we do with our next dollar, how can we get the best performance out of that, and certainly how can we kind of change the filters, the diligence process that we were undertaking. Manager selection is key, especially for someone like us that we have limited internal resources, so we're not doing it ourselves. We are relying on best in class. I don't want to overuse that term, but that's exactly what you're looking for. And it's not exactly big is best. We try to invest both with operators and with top performing allocators. So the output of this exercise was we had short lists of operators in markets that we wanted to be in. And fortunately, New York City is our home city. We entered into some conversations and ended up establishing a new investment program with Taconic Partners, which is the name that you're all familiar with. I would also say that some of the things that we've done in the past that you might be familiar with is the City Investment Fund. Jeff also mentioned that I have some responsibilities for economically targeted investments, which I think is very, very unique in terms of being a U.S. Institutional investor. There's a 2% sub-allocation across all asset classes dedicated toward bringing capital to underserved communities in New York City, right here in New York City. And so that has generated a lot of activity, certainly have kind of gentrified some areas, and we feel that we're an important part of that. So for various reasons, of course, all being prudent decisions, being a good fiduciary, we do try to bring capital into New York City at all points of the cycle.
Thanks, Yvonne. Pete Madden, you heard there's one sort of willingness on the part of Oxford to be an operator, desire on the part of CPIB to be more of an allocator. Where does APG fit into that mix? And how do you execute it?
Well, I would say we're probably more in Peter's camp. An allocator where we have staff here in the U.S., but for the most part we invest indirectly, so we need to invest with partners. And so for the most part, we, as I mentioned before, we really go through funds as a way to really get access to real estate, and as well as the public markets.
And how do you access those funds? There's been a lot of bad publicity these days around the whole notion of placement agency. No offense intended to placement agents, but it's just been a topic of a lot of conversation. Do you find that you're being brought fund opportunities by placement agents on a regular basis? Do you have to be more proactive to go out and find the fund managers? How does that whole process work from your point of view as a prospective investor?
I think it works quite well. I mean, we do have a number of placement agents bring operators through, and they serve a purpose. They have efficiency of getting meetings with people. They can kind of pre-screen and whether or not it's an asset class we've historically liked to go into. So I think they serve a vital purpose. But then again, it's also just word of mouth, and folks just come to conferences like this and people call you up. We're here in New York. We know a lot of people in the market, so And we have a tendency also to go with managers we've known and invested with in the past. As you know, when you start these relationships, it's a very long process, and it can be kind of a very painful process to establish the first-time funds with folks. And we like to make sure that we're doing this with people we want to invest with, 2 to 3 times over. So we find ourselves really going back to the same groups unless there's been a major blow-up or poor behavior or performance in the previous fund that was not the market but more the manager.
Well, going back to some of the things we heard earlier today, I'd like to ask each one of you to comment on where you think expected returns for real estate should be, and pick your poison, whether it's the opportunistic space you work in, development, as in the case of Oxford Properties on Hudson Yards, mezzanine. Pick a slice of the capital stack and tell us where you think expected returns should be going forward and what that is relative to what you've experienced, since the downturn. Start with Peter Ballon.
Can I kind of alter your question?
You can do
take
anything
it where
you
I
want.
want. I mean,
we're not paying you, so you
okay,
can do whatever
fine.
you want.
I mean, we look at every transit it's going to sound like I'm avoiding the question, but we look at every single transaction very uniquely on what we just call a risk-adjusted basis, and that goes for markets and countries and sectors. And so the way we look at it is purely on a risk profile. And so if you go to the extreme, we'll look at emerging markets, which is a very big part of our business plan. We'll look at a place like Brazil and say we need returns of certainly 20% or above. And I should mention, when we talk about returns, we look at deals, as do all investors, from various metrics. But just for your information, the Canada Pension Plan probably looks at unlevered IRRs as probably the key metric in any one equation. So that's the one metric we look at the most. And then we'd kind of move down. So Brazil's in the 20s. Let's go to the extreme, which would be a market like a London or a New York. If you're looking at core returns these days, I think the market is actually, and multifamily would fall into that category, I think the market is underwriting to 7s. I'm not sure if, I think there's sometimes euphoric assumptions to get to 7s when you're starting at 4 in some sectors. But I do think the market is looking for mid-7s for what I'd call the core real estate. And then for development, various investors have views in terms of trying to get an extra 100 or 200 basis points. To me, the key isn't exactly what the return is. It's kind of what's the embedded assumptions, because we can all convince ourselves that you're getting a 9% return because things are going to grow at 5% per annum. I think what's more relevant is making sure you got the right assumptions in your model. The market tells you what the pricing in is, and then you can decide if you actually want to do the deal or not.
So along that theme, I made some notes in an earlier panel, and the general consensus seemed to be that you need to invest today assuming slow growth. Everyone's talking about slow growth. Our CIO guest speakers spoke about 1.5 to 2%. Are there pro formas sitting on your desks, or starting with you, Peter, again, is there a pro forma on your desk that shows growth in the U.S. of anything above, call it 3% for argument's sake, in any asset class?
Yes, and I don't like to admit it, but because it's always easier to say we just underwrite to 1% growth. But there are markets where we think that there is higher growth. There's some multifamily opportunities out west. And when we say markets, it's very asset specific. And we know that every asset is subject to a larger market. But when you're investing in an asset, it really matters what's happening in terms of the 3 competing properties around you, what's the dynamics, vacancy, et cetera, et cetera. And so there are some examples where we'll see and underwrite 3.5 or 4%. I think where we try to add a little discipline, which is what is different than what you see, and if I can use the term vendors packages or brokers packages, is that those returns don't survive forever. It's not like you're going to have 4% forever. We will see maybe 1 or 2 years, especially when there's zero supply coming online and there's vacancies of 0.2%. We actually think you can grow 4%. That's 1 or 2 years, and that's when you have to go to a more stabilized 1 or 1.5 to 2%.
And by asset type, I know you're fond of the multifamily sector. Would you rank the multifamily sector overall as the most desirable from a fundamentals point of view in the U.S., or would you have a different selection?
In terms of fundamentals, yes, I think in terms of short-term fundamentals, so let's differentiate between short-term and long-term. Short-term, there's actually some multifamily fundamentals, I think, actually can grow. The challenges, which is why we're almost exclusively doing development, is that growth has already been priced into the market, which is why you're seeing 4% cap rates in multifamily, where it is in suburban office, you're seeing 8 or 9%. The market is pretty efficient at this stuff. And so, yes, there's the growth, but there's the 4%. And since we look at things on a total return, for the most part, even when you factor in 3 or 4% growth, an acquisition still doesn't make sense in multifamily, even though it has the best fundamentals out there.
So, Pete Madden, you've invested pretty actively in Brazil.
Yes.
How much of that is development? How much of that is buying existing assets? And which asset classes have been your favorites?
It's all development.
It's all, sorry?
It's all development. It kind of runs the spectrum. We have investors, we have funds that develop industrial parks to take advantage of the expanding retail. We have groups that will be developing retail malls in secondary and tertiary markets. We have funds that are developing office product primarily in Sao Paulo and Rio. And we have a lot of for sale housing, mostly in the middle class housing. The returns, I think, as Peter was saying, is 20%. I think that's kind of the number we look at doing, we look to achieve. It's all pretty much unlevered as well. We've been achieving those to date. We've got a significant amount of capital in Brazil, but we haven't seen any money coming back. So I think at the end of the day, hopefully the nice thing is the single family developments are they're self-liquidating. But there seems to be a lot of interest going down Brazil, and cap rates are tightening a bit on high quality products. So hopefully we can exit and get those 20s, maybe 25s returns down there.
So, question for you, Yvonne. How much of your incremental investment going forward, forgetting about what's already been done, do you expect to be in core, how much in value added, and how much in opportunistic? If you just take those terms loosely. I personally don't like those terms, but for purpose of discussion, tell us about that.
Okay, so perhaps let me describe what our investment policy is. So in terms of the portfolio construction for our real estate program, we define the investment strategy as kind of like a core/core plus, and then opportunistic. So the policy says that for core plus, that we can be within 40 to 60% of the portfolio, and likewise for opportunistic. What that does for staff is it kind of creates this kind of 20% place where we kind of have the flexibility to move one way or the other, depending on where the market is. As it relates to core, we are probably not going to be investing in what you would consider traditional core in the near term. We think that is overpriced. We do have some significant holdings in some open-ended funds. We did try to kind of game the system somewhat in getting to some core open-ended Qs in 09 and 10, so by the time they got to us, the unit price was sufficiently low. But as it turns into trying to access core right now, we're actually kind of looking on the debt side because of the opportunities there and the ability to achieve equity-like returns with debt, and also having that equity beneath you. So, as I mentioned before, we have a short list of folks that we're having conversations with, and as Pete mentioned, you want to kind of hone in on folks that you can develop programs with. And so for those that have a proficiency in originating, we'd like to be able to participate with them, and then for those who do mezz, and so on along the spectrum. So then we're also particularly interested in value, because we also think we could, with the right partner, achieve outsized returns there, because certainly capital is chasing that core product when the deal is either broken because of its structure or for whatever reason, there seems to be a premium being attached to that. So in some cases, if you're careful and if you're lucky, you could turn out being overpaid for that. And of course,
being overpaid or overpaying?
Pardon me?
Being overpaid or overpaying?
Oh, excuse me. Being overpaid.
Okay.
We all like to be overpaid.
Yeah.
I vote for that. Andrew, similar question. with respect to OMERS, what is their real estate investment policy, briefly along the lines of what Yvonne was describing, and how do you go about executing that or even influencing it to say, hey guys, here's what you think you need to do, but we're in the markets and here's what you really should do?
Right. Good question. I think two things that people should know about OMERS is relative, especially maybe to our U.S. pension peers for OMERS. OMERS has today about 42% of its, call it $60 billion in net assets in private assets. And that's broken down into private equity, infrastructure, and real estate. And to get a sense of how our, at least the board of OMERS of the pension plan looks at privates and its allocation, and real estate would today make up about 13.5% of OMERS. They actually delegate that authority to a business unit that's headed up by our CIO. And so what OMERS has made desire to go to is a 50-50 split between private assets and public assets. So a significant continued growth into the private asset classes, and I think candidly that number, when it gets to 50-50, will likely shift even more into the private assets. And so that allocation is actually delegated to the business authorities to then say, you guys tell us in the private businesses of which you operate, real estate being one, where the best opportunities are within that 50%. So we have, although every organization has soft targets around allocation to whatever business unit it is, real estate or infrastructure, we're no different in the soft target, but really it's driven by opportunity. And so we often meet with the board and obviously meet with the CIO on a regular basis talking about where we think the opportunities are for our private businesses. All the heads of those businesses sit together and really determine where unique opportunities may be coming forward. An example of that in terms of speed of execution, which maybe I'll hijack the question a little bit about the fact that Oxford, although an operator in Canada, is not an operator in the United States nor in Europe. But we think we can take operator-like risk, and we're more local from our perspective to hopefully be a better partner. So we view ourselves as a good partner, a smart partner, and we can unearth opportunities by being local as much as it is about wanting to be an operator. And when I say that, I look at our program 8 months ago when we were in the U.S., physically present here roughly a year ago. Debt as an acquisition target was not even in the business plan. We now have an allocation internally of $1 billion towards buying various debt and recapitalizations. We've deployed probably $500 million in 8 months. So we can move where we think they see opportunity in mispricing the capital structure, and hope that by being local we can continue to convince our organization of where to take advantage of those opportunities.
So looking at the investment world, I always say that the investors are much more interested in the return than anything else. But many of the people in this room are interested in other things besides the return, although the return is very important to them. Like, for example, fees and promotes. Perhaps there's one or two people in the room who's either an existing or a potential JV partner or an existing or potential broker on a transaction. I think it might be interesting if we could just start with Peter and go down the row and answer this question or your version of this question. How has compensation to either partners or managers or fund managers changed since the crisis, and how do you expect it to change going forward, if at all?
I don't think our strategy has changed due to the crisis. I think our view on fees is that we are comfortable, although we don't like to overpay, we are comfortable paying our managers for doing the work that they do. What we really want to do is always ensure alignment, and so our fee structures are geared to ensuring that our partners get paid for creating value. We don't want to pay for just being there for kind of having our capital. There has to be some value created, and if our partners create value beyond what was expected, then we think that they're entitled to share in that. Just a little bit, though.
So just to push you a little bit more, has there been any shift from your point of view in either compensation being moved to a more fixed model like a standard fee, or more to a incentivized model like a more of a promote? Any of that in the last couple of years?
I mean, I can't speak for the market. I know in our case, we very much prefer a promote type model, because that just encourages what we're trying to achieve. And it's more complicated than promote, because what we are constantly trying to do, because of our model being capital allocators, we're dealing with best in class, et cetera, et cetera. At the end of the day, though, we're trying to always ensure alignment. We want our partners to do what we want to do, and vice versa. A lot of the time spent building with partners, the initial chat is, are you good? Okay, well, we're only talking to you because you're good. Now make sure we have the exact same goals. And those goals can be about investment horizons and leverage, etc. We don't want to compensate our partners for leverage, so we try to compensate on a non-levered basis as opposed to a levered basis, because they're operators, they're not financiers necessarily. We don't want to compensate them for a quick hit. Okay, we're going to build this thing, sell it in 2 years' time, because we want to hold it for 10 years. So an example of that is, well, we'll pay you the promote after 10 years. That's a long conversation, so it never gets to 10, but it's not after 2 years. So I just do want to emphasize, it's not just about the dollar amount, it's not just about a promote, it's the timing of that promote, it's really trying to ensure greater alignment.
It's about alignment of interest, clearly. So I'm going to ask the same question of the other three panelists and then give you guys a minute or two. If any of you have a question, we'll have time for maybe 1 or 2 questions when we're done with these. So Pete, same question for you.
Yeah, I think it's a combination of both current fee and as well as promote. I mean, we like to have things paid. We've been trying to move as much as we can to paying on invested capital. And as Peter's saying, we want to align the promotes to have a hurdle high enough to where they start sharing once really the value added is being achieved. I do think, though, when you look at managers, you can't just put them all in one bucket. There are some emerging managers that may need a higher fee to make sure. You want to make sure that they have a sufficient income coming in to make sure that they can maintain their current operations and manage things in a professional manner while the promote is still 5-6 years out. So what we do is we really look at the managers, the fund, not just the fund, but the manager's entire income statement and see how much money they make in other fees, and then we try to tailor it to make sure that they're not making so much excessive profit on fees, and then we'll try to push more to the back end. But I think it varies by manager. I think as managers grow larger and larger, they should be more flexible in, being paid on invested capital as opposed to committed capital, and be willing more to take things more on the back end.
Yvonne?
I'm not going to say things that are probably not too different from Pete here, but I would kind of accentuate something over the history of pool funds. And as I mentioned before, New York City has invested primarily through those pool funds. Management fees are not supposed to be a profit center. And over the course of time, through various things, that's what it came to be. And I mean, Pete kind of talked about how you have to look at each manager individually, and I think that that's so true, because you have managers that are employee-owned, you have managers that are institutionally owned, and you really have to be cognizant of that when you look at the entire fee structure. First of all, you got to look at the totality of it. I'm going to just try to pick it apart just to make a couple of comments. As I mentioned before, management fees should not be a profit center, and over the course of time, as funds grew larger and larger, the management fee formula stayed the same, yet there was no recognition for any economies of scale of does it really cost twice as much to run a $2.5 billion fund as a $5 billion fund? And the market being as it was and the capital streaming in, it was really market driven. Despite that you might feel that way, they were fellow investors who were just kind of like signing on the dotted line. So now the pendulum has swung the other way. And so it's not that LPs are running around trying to beat down managers. It's that we're just trying to get to a practical, reasonable place where there is a proper alignment of interest. And I guess in my view, I target the management fee. I also, and I'm probably not alone in this, don't like the catch-up either. But like I said, there are changes in new funds. You see management fees being based on invested. You see, catch-ups going away. And so, we are moving, I think, toward a better common ground between investors and GPs.
Andrew, do you have any comments to add to that?
Yeah, we're not a pooled investor, so I can't really speak to how...
so on the joint venture front, for example?
So I would say the only thing I'd add, and I would echo a lot of the same comments Peter made, because I think obviously alignment is the critical element of any compensation. I would say from our perspective, I think we have a sober view of it because we like to get paid for what we do in our own market. So I think we can look at it from an operator's perspective. But generally, I think what we try and use as our best alignment tool is really to make people get people compensated that aligns with the strategy of the investment. So I think we did historically and had run into some problems with is perhaps in the extreme example of an operator who was expecting we were going to get involved to sell an asset in 2 years and then we want to hold it for 10 as an extreme. If those things aren't figured out initially, you have people doing things in the wrong interest of what everybody's trying to get accomplished. So I would say that we don't sort of live by a particular model in any instance, but rather I think if you can hold by alignment and strategy of the investment as the driver, then you get things aligned a little easier.
Great, thanks. Before I ask them my last question, does anybody have a question from the audience? I think we have microphones at either end. Sorry? Sure.
Quick question for Yvonne. For your investments in the underserved areas, what is your expected return? And is that a market return or a subsidized return?
That's an excellent question because it's a market return. And I know that people may believe, you know, we're New York City and we're here to help the city, and we are, but we're a fiduciary. And some of the problems that we've encountered with some of the proposals, and by the way, there is an open-ended RFP on our website, so you can pitch proposals to us anytime. You can reach out to us and make appointments if you want to kind of, you know, get our feedback before you submit something formally. But the answer to your question is actually that we need a market rate of return. So consistent with the strategy that you're proposing, if in a market environment, an investor would get looking for X return, we would have to, your proposal would have to get us there.
Any others? So also, in the interest of time, let me summarize by saying that we have 4 very experienced and very active institutional investors on the panel, and what we've heard about is not necessarily traditional investing in core plus real estate assets. What we've heard today, I think, is a lot of development, some debt as a substitute for equity, willingness to partner and do some interesting and creative things, like Hudson Yards, like buying into large portfolios here in the U.S. and around the country, development in Brazil. So the institutional investment world, I think, has really come around in the last few years to accessing real estate in a variety of creative and unusual and perhaps unexpected ways. So with that, let me thank the panel.